welcome everybody. We're going to get started almost on time today. Welcome to the Stay Strong webinar series presented by the Hustle Firm. Big day today for forgiveness and bringing back, and John's a little overdressed, I would say, today. Thought we were going with the t-shirt look again.
I already got my hustle on, my run, or the hustle t-shirt. It's just too sweaty to wear on the webinar today. So.
Yeah. So, anyways, I'll be the lazy guy today. So thank you again, presenters John Rizzo, managing partner here at RDG, myself, a partner at RDG. You're stuck with us this week. And technology reminder, Q&A, throw those questions in the Q&A section. And then if you see another question that is similar to yours, before you ask another one, just like theirs, and that'll push it to the top. If you have issues, we got Shelby running behind the scenes. She'll make sure that everyone can hear us, everyone can see us, our video isn't fuzzy. So if you see something that we're not looking right or not sounding right, just shoot it in the chat. And we will get the slides and the recording out after the webinar tomorrow. All right, John, you want to kick off our agenda?
Yeah, here's our agenda for today. So we're going to have some latest news, and news just keeps updating. There was another set of news that came out yesterday. So we're going to go through that. What's changed? There have been changes as well. There's pending changes and actual changes that have occurred since last week. So it's amazing every week, changes keep occurring. We're going to go through a more detailed and complicated forgiveness application. So hopefully that'll answer a lot of your questions. And then we will go through additional questions as well at the end with the Q&A session. Thanks everyone for attending. I know some of you have been on here every week. We've been doing this for over 2 months, all of April, all of May, even part of March. So thanks everyone for attending and spending the time with us. Hopefully everyone's staying safe and healthy out there. And thanks to our research team behind the scenes. Today we have Tim Hearn behind the scenes answering questions, and Chris Gamble as well, both partners here with RDG. And Dan mentioned Shelby is making sure all systems and controls are working. And thanks to Crescendo Design for our great PowerPoint presentation here. We're ready to go.
Awesome. All right, so latest news, we're going to focus, as much as I love Twitter, I guess we're getting censored on Twitter anyways. So just real quick recaps of this is May 15th, the SBA and Treasury released the Paycheck Protection Program loan forgiveness application. They released some rules, some clarifications. We knew about that last week. And immediately the Senate and the House began to focus their attention on the 8-week time period, all recognizing that small businesses need more time to spend the funds. So the Senate was the first to introduce the bill, Senator Joe Manchin, along with Romney, Leahy, Gardner, and Wyden, bipartisan legislation in the Senate. And again, 18 to 16 weeks is the first part that they introduced. The House also introduced their legislation, which I'll get into in just a second here, but that's pretty much what we've been focused on. Is the forgiveness application is out with some clarifications. There's been interim final rules that have come out, and the bottom line is the significant things that the SBA cannot change are statutory in nature. It requires an act of Congress, which is why Congress has been working on some of these fixes that we're about to go over. So pending legislation, just want to remind everybody of the bills that are going through the chambers right now. We've got PPPL taxability. There has been no change to this getting advanced at the moment. They introduced it, and it has not passed at the moment. So reminder that the income is tax-free, but then the IRS came out and said, well, that means we're not going to allow deductions for those expenses that you're reimbursing. So the Senate said, well, wait a minute. That's not the intent. Our intent was you get tax-free money, and that's the end of it. So that's what this bill 3612 is intended to do. No forward progress on there, real forward progress on there since the last time we updated you. As I mentioned, the group of senators introduced the Senate bill to extend the period from 8 weeks to 16 weeks. They've also thrown support behind being allowed to use some of the non-payroll covered costs for PPE, so that personal protective equipment and investments that you need to make in order to get things reopened. So they're adding a lot of flexibility, hopefully, in this bill. The House has a separate bill from the Senate that they've introduced, similar lines, extending the period, but instead of 16 weeks, it's 24. They're getting rid of the requirement that you spend at least 75% on payroll, which would mean you could spend more of your non-payroll costs with the money. And then if you don't spend it and get it all forgiven, which would be highly unlikely in any of these scenarios if they extend the period, the loan goes from a 2-year loan to a 5-year loan. So again, extending the period, getting rid of the requirements between the two, and the loan term are all things that require an act of Congress, and that's what they're working on. So those are the pending legislation pieces. So what's changed? A lot of these we went over last week, but there was additional clarifications because last week we focused on the clarification that came out in the forgiveness application. And subsequent to that, on the 22nd, they released an interim final rule, which largely mirrored the application but had some minor tweaks. So we're going to kind of merge those changes, remind everybody about the clarifications that have come out, and then we'll get into the application forgiveness application. So first one, cash versus accrual. Do I use the amounts that I pay during the 8 weeks, or do I use amounts that are incurred during the 8 weeks? So both the application and the interim final rule have allowed for flexibility here, welcome flexibility, that payroll costs that you pay and payroll costs that are incurred are generally eligible for forgiveness during the 8-week period. So that means that if your loan dropped on the 3rd of April and you paid a payroll that day for the prior 2 weeks, that would count. And then during the 8 weeks, all the payroll that you're incurring would also count as long as it was paid within the period or within the next regular period. For non-payroll costs, the costs that are paid during the covered period are included, or costs that are incurred during the covered period and paid before the next billing date. So rent is a good example. If you have not paid your March and April rent and then you got your loan, you could pay both March, April, and May during the covered period. So it's possible here that more than 8 weeks of payroll could be forgiven, and this is one of the things that John's going to go through. So added from last week, we said, well, what about costs outside the 8 weeks? Obviously, we talked a little bit about that, but some nuances. Number one is they were very clear that you cannot prepay interest on debt. For whatever reason, they singled this out and said, hey, you can catch up if you're behind on your debt payments, but you cannot get ahead on your debt payments. You may, however, be able to prepay rent and utilities because they said nothing about not being able to prepay it. So the lingering question is, why would they leave that out? So we're conservatively saying I wouldn't do any, I'd make a good business decision first, but you may be able to account for example, if you paid June rent right now and it was during the covered period, that may be able to be a covered cost. And then they were very clear that if you pay costs during the 8-week period that were really for like March and April before you got your loan, those can be included. And they actually put some context in the interim final rule and said they're not so concerned about the ability to prepay or catch up at the moment because there's a 25% cap on the non-payroll covered costs that you can incur. So to be determined if they keep this language or expand on it if they get rid of the 25% cap on non-payroll costs. But at the moment, you can catch up. You may be able to prepay on rent and utilities. For the 8-week period, when does the 8-week period start? So reminder that in general, for payroll and non-payroll costs, it's usually going to, the 8-week period is going to be the date of disbursement of the loan. However, for payroll costs, you have the alternative covered period, which means that you can start your 8 weeks on the first day of the first pay period following your loan disbursement, which is really just administratively easier to track if you can just run a payroll report. Our recommendation here is when looking at your 8-week period, consider both periods and determine which one is best for you. You choose, the borrower chooses, which means look at both and whatever works out in your favor, pick that one. So that would be our advice for the 8-week period. For interest, no clarifications have come out since our last webinar last Thursday. It says business mortgage interest for any business mortgage obligation on real or personal property. So there's some conflicting terms around mortgage and personal property. Personal property is not like your personal boat at home or your couch at home. It's personal property would be machinery, equipment, fixtures, within your business. Real property is your building. So interest around your building obviously qualifies. There's some confusion on personal property, so we're still waiting for clarification. Regardless, the strategy here is track both. And I would say that if your debt is secured by assets of your business, I would consider that interest that would be covered under this loan. So again, need some clarification from SBA and Treasury on this, but track both, and we'll see if they come out with further guidance when you go to apply for forgiveness. Owner compensation. So how much can an owner take? This was a relatively big one where we always knew that owners were capped at $15,385, which is the 8-week equivalent of $100,000. But then they limited that to or the 8-week equivalent of your 2019 compensation. So if you as an owner paid yourself only $75,000, you can only take the 8-week equivalent of that when applying for forgiveness. So if you were $75,000 last year and $50,000 this year, you can get yourself up to $75,000, but still nonetheless important that it's the lesser of $15,385 or the 8-week equivalent of your 2019 compensation. The point that they came out with in the interim final rule on the 22nd was this applies to a particular individual across all your businesses, which means if you own multiple businesses, you can't pay yourself $15,385 out of each business. You as an individual are limited to $15,385 no matter how many businesses that you own. So it's important that you would want to track your individual reimbursement across all your entities. Bonuses. So very common question, can I pay bonuses? Can I pay hazard pay? The absolute final answer on that is yes. They actually have an example of can you pay hazard pay? Remember that the bonuses and hazard pay are for the employees because the owners are capped at 2019 compensation or $15,385, and the amount of bonus that you can pay is capped at $15,385 for those employees. So you could pay more than that for sure over these 8 weeks, but currently you're going to be limited to how much is going to be forgiven. So this is limited to employees only. It does not apply to owners, but yes, you can pay bonuses, and yes, you can pay hazard pay as long as you keep it to the $15,385. FTEs. So first important point is they defined an FTE as 40 hours. So very clear there. We had kind of been predicting it'd be 30 based on the Affordable Care Act. It's 40. Then they say you can calculate your FTEs based on a 40-hour work week, or you can use a simplified method. That is, if your employee works 40 hours or more, they're a 1. If they worked fewer than 40 hours, they're a 0.5. So we got a lot of questions last week of, well, does that mean I have to use a 1 or a 0.5? The answer is no. Remember, you can choose as the borrower whatever's best for you. So the important part is to look at it both ways. If one way works out better, then you would use that. And if you get to the answer of you're not going to limit your forgiveness based on FTE reduction on either way, then stop there because that's all you need. FTE reduction. So what about employees who refuse to come back? Again, they mentioned this in the forgiveness application. They clarified it in the interim final rule. For any employee that you haven't replaced, the following 4 things are not going to count against you. If you made them an offer and they refused to come back, that's not going to count against you. If you fired them for cause, if they resigned, or if they requested a reduction in hours, that does not work against you in the application. So the very important thing is to make sure that you document this in writing and keep track of it so that you don't run into issues down the road. You do not want a verbal agreement between employees. Pay reduction. This is one thing we did not touch on last time. So there's 2 ways that your forgiveness amount could be reduced. So first, after you've spent the money, your amount of forgiveness could be reduced if you reduce your number of FTEs. We just went over how to calculate that and what they mean by that. The second way your forgiveness could be limited is if you reduce people's pay. And they came out with a lot of clarification around this. We'll go through bullet by bullet. So the first thing is you compare people's pay during the covered period to the period of January 1st through March 31st. So what their average rate of pay during the covered period compared to the first quarter. The second part is this does not apply to people that made over $100,000 in 2019. So they don't really care about highly compensated employees if you reduce their pay because they're considering that those employees make enough money. This is an employee by employee calculation. So what you will want to do is you want to look at it for each employee. And it's not total pay over the time period. It's their rate of pay. So if you as an employee were making $1,000 a week salary, as long as you're continuing to make $1,000 a week salary for working the same hours, you're okay. If you had an employee that was working 40 hours during the first quarter and they were getting $20 an hour, and then you drop them to 30 hours but pay them $10 an hour, they care about the rate reduction from $20 an hour to $10 an hour, not the fact that you reduce them from 40 hours to 30 hours. So the important part on the limits around pay reduction is you cannot reduce employee pay by more than 25%, and it's the employee's rate of pay, not the actual amount that they get. Double reduction. So I talked that there's 2 ways that you could reduce, that you could get, penalized, I suppose, if you reduce FTEs and if you reduce employees' rates of pay. The important thing is they came out and said you're not going to get double penalized because you took someone from 40 hours to 30 hours. You will only get double penalized if you reduce somebody's hours and then you reduce the rate of pay that you're paying them for the reduced hours. So the note here in the strategy is track each employee, track the FTEs for them, and track their rate of pay when you go to calculate forgiveness. But you unlikely will be double penalized for people that make less money. All right, so with that, those are the major changes. Now I'm going to kick it over to John. He's going to go through the application, forgiveness application, the more complex example.
Great, thanks, Dan. You can see there's a lot of changes that have come out over the last week or so, and we'll go through a more detailed and complicated application example here. So let's get started. So you'll see here on the first slide our example, and on the left-hand side are all the assumptions that we use in the example. So the first assumption is in the base period, this organization had 4 employees, and in the 8-week cover period, they dropped to 3 employees, so 1 was laid off. That's not necessarily FTEs, it's number of employees. You can see on the right-hand side, the main application form that was completed. Their loan amount was $73,750 and was funded on May 6th. The company has a bi-weekly payroll. The pay period before the loan was funded ended on May 8th. So the 5/6 date was part of that May 8th payroll, and that payroll was actually paid on 5/11. This is important information that you want to gather the before period payroll and the first period after. The next pay period begins on 5/11 and goes through 5/22, and that one was paid 5/25. So they have a 2-week payroll, and then after the weekend, their payroll is actually paid on a Monday. So in determining what should we be using as our covered period, we have options. We can use the loan disbursement date of May 6th, or we can use May 11th, the start of their next payroll. In this case, we chose May 11th to July 5th, and the reason is because of the rule that says you can include payroll costs that were paid and incurred. So if you look back at the assumptions, the payroll that ended May 8th was paid on May 11th. We're going to start our 8 weeks on May 11th. So we're able to pick up that period, and we're essentially picking up an extra 2 weeks here. And we're going to start our loan then on May 11th and go 8 weeks out. So a lot of strategy there, and it was an easy decision to use the May 11th date for this particular application. So you're gonna have to look at both of those dates. Additional assumptions, the company pays $500 per employee per month for health insurance. They do not pay retirement benefits. Their rent is $5,000 per month. Their utilities are $2,000 per month. And they have interest on debt, but it's not mortgage debt of $1,500 per month. So with all these assumptions, you'll see, we'll come back to the loan forgiveness application main page after we go through some of the sub pages that need to be completed. So let's look at the next slide. All right, so now we get into the wages. In this case, like we mentioned, we had 4 employees in the base period. One of them, employee 2, was laid off prior to the 8-week period. So here are the wages. Employee 1 was a 0.5 FTE. We chose to use the simplified method for FTEs. So that person on average worked under 40 hours, and they continued to work under 40 hours during the 8-week loan period. Their pay did not change. Employee 2, $60,000 wage, was a full-time 40-hour FTE, and they were laid off and dropped to 0, and they did not come back. Employee number 3 made $70,000 in the base period and worked 40 hours or more. In their pay, they received a bonus, or actually a salary increase, and their pay went up to $100,000 in the 8-week period. Employee number 4, they were compensated $120,000 in the base period, and they also had an increase in pay to $150,000, and they were over the 40 hours as well. And then the owner, so in the case of all these applications, the owner is not considered an FTE. So that's something that we clarified last week. So the only individuals included in your FTE calculation would be the employees themselves. The owner in this case earned $50,000 in the base period and then increased their pay to $100,000 later on. That'll come into play in the example. So if you look to the right, if you're able to see it well, now you have to break this down into the different tables. So table 1 would be any employee that earned under $100,000, and table 2 are employees that earn $100,000 or more. Now remember, we're using 10 weeks of payroll here because of the covered period. So in the case of employee 1 who earned $50,000, 10 weeks of payroll for that individual is $9,615. So that's the amount we would include for employee 1. Employee 3, we're going to skip employee 2 because they weren't paid during the 8-week period, so they'd be a 0. Employee 3, if you look at the chart, was a $100,000 wage earner, so they go down in table 2. As you know, the maximum amount that you can pay under this program for any individual for compensation is $15,385. So even though we're able to use 10 weeks, we're capped at the $15,385. The same goes for employee 4. Their wages were $150,000. We have to cap them at $15,385. So when you add that pay up, we have $30,770 that is paid for the over 100,000s. If you go to the bottom where we calculate the FTE reduction safe harbor, what this takes into account is if you've added anybody back by June 30th. In this example, we laid the only employee that could apply to would be employee 2. Employee 2 was laid off, and employee 2 was not brought back prior to June 30th. So we have no FTE reduction safe harbor here because we did not bring anybody back. Now, this also comes into play that a strategy item for this organization would have been to bring back somebody, employee number 2, someone in that position by June 30th so that their loan forgiveness isn't limited. So with that, let's jump to the next slide to look at how this all rolls up. And as we mentioned last week, each table in the application, it's an 11-page application. Each table rolls up to the tables in front of them. So if we take the information from table 1 and enter it here on the PPP Schedule A, line 1, we had $9,615 in table 1. We had a 0.5 FTE, and we did not have a salary or wage reduction because everyone earned at least 75% of what they earned before. So there's no wage reduction like Dan pointed out earlier. That is table 1. The next section, line 4, is table 2. So if we take the total compensation of the over $100,000 compensated employees, we get $30,770, and they were 2 FTEs total there. All right, the next section. Now what comes into play is health insurance. As we mentioned before, the health insurance was $500 per month per employee that was paid by the company. We're picking up 10 weeks of health insurance based on the payroll dates. So from here, the amount of health insurance we can include as forgiveness is $3,462. Line 7, we had 0 retirement contributions. In line 8, we had 0 employer, state, and local taxes. So that completes the next section. When we look at the owner's compensation, remember the owner in the base period was compensated $50,000. In the 8-week loan period, they were compensated $100,000. The rule for owners is that they can't be compensated or forgiven any more dollars than what they were compensated in the base period. So we are stuck with the $50,000, and 10 weeks of $50,000 is $9,615 for the owner. So in this case, the owner loses out here because they did not compensate themselves enough in the base period. So their number is $9,642. So what we do from here is add up all the payroll dollars, and we get to $53,462 is the total of all the payroll costs. On the bottom, we're now comparing FTEs. One of the requirements for forgiveness is to maintain employment. Well, in this case, we had 3.5 FTEs in the base period, and we only have 2.5 FTEs in the covered period. So because of that, our factor now is 0.71. So we are going to lose some forgiveness because we failed to meet the requirement of maintaining employees. So let's go to the next slide. So this next slide kind of wraps it all back together. So if we look at the top, we have the loan amount, we have the loan disbursement date, we have the employees at the time of the loan application of 4, we have the employees at the time of forgiveness of 3. This company did not receive an EIDL advance amount. Had they received it, they would have to return that. They have to be repaid as part of the PPP. Their payroll frequency is bi-weekly. We chose the alternative payroll cover period of 5/11 to 7/5, like we talked about before. And this loan is not in excess of $2 million, so we don't have to check that box. So now, when we roll the other schedules into this schedule, our total payroll costs are $53,462. This is taken directly from line 10 of the PPP Schedule A. Business mortgage interest payments. So if you look to the left in our assumptions, we had interest on debt, but it was non-mortgage. So because it was non-mortgage, right now, based on the guidance we have, we chose to put 0 there for that item. Business rent or lease payments. If you look to the left, the assumptions is that this organization had rent of $5,000 per month. We're not taking a full $10,000 though, because 2 months is not 8 weeks. We are only taking 8 weeks of that. And the rent amount is $9,231. Same with the utilities, $2,000 a month. We are not taking $4,000. We are taking 8 weeks instead of 2 months. That amount is $3,692. Next section, line 5, we don't have a wage reduction because we kept everyone's compensation at least 75% of what it was. And we add up all these costs. So when you add up all the costs, this company's potential forgiveness was $66,385, even though the loan amount was $73,750. So they did have opportunities here to receive more loan forgiveness that they missed. They did not bring an employee back, and maybe they could have had more bonuses go to the one employee that was earning more, that was under $100,000 and earning more, could have earned more compensation. So when you pull out the FTE reduction amount, remember from the other page was 0.71. So we have to reduce the $66,385 by that factor because we did not bring everybody back. So the modified total now for forgiveness is $47,133. So we compare these three numbers, the 47, the loan amount, and then we wanted to compare a 75%, at least 75% of this, the dollars were spent on payroll. So when you take these three, the forgiveness amount can only be the lowest of these three numbers. So in this example, this organization will only be forgiven $47,133 out of their loan of $73,750, which means over $20,000 will turn into a 5-year loan at 1%. So I know that's a lot to digest, and we didn't go through all of the other pages that have the certifications and more or less the instructions and rules behind everything. But here's more of a detailed example for everyone to review. And when we send the recording out and the slides out, you'll be able to spend more time looking at this as you're preparing your loan application. But as you can see, it can get pretty complicated, and strategy is very important here as you work through your cover period.
Awesome. So thanks, John, for that example. Just a reminder to everybody that, you know, there are a lot of resources out there. Payroll companies are one good example. Don't forget to use your resources. So some of the payroll companies have PPP loan forgiveness reports that you can run out of there. For example, RDG payrolls, you can go in, you select PPP loan forgiveness reports, and it'll give you the FTEs, it'll give you the wages for the periods that you need. So use your resources, use your payroll company to help, and obviously use your accounting system and let us know if we can help in that regard at all. Another reminder on strategy, again, important to start completing that draft application so you know what your situation is. You know, think about, now that we have no caps on bonuses except for the 15 through 85, we know more about the FTEs. You know, consider going through that strategy and seeing what is going to be forgiven, and maybe updating your strategy based on this new guidance, because before, if we made decisions about bonuses that weren't going to happen, it might be a good time to update that strategy. And again, good business decisions always prevail. And it's important to continue to monitor all of the pending guidance, the pending legislation that's coming out. So it's important to both update your prior strategy and keep an eye on, as we've talked about, all these pending changes to make sure before you go ahead and make a decision. More guidance is obviously expected, and stick with us. We're obviously monitoring that. So Q&A. We've got 43 questions answered so far. Research team is just knocking it out of the park today. Let's see if a good question. This has popped up a couple times actually from this one from Joel Meredith. When is the application due? To my knowledge, currently there is no due date for the application. The banks will have 60 days to approve your application once submitted. But what we will say is, and we've been saying this, there's no reason for you to submit the application right now, considering all the significant changes that are about to happen. I think we were just looking before the webinar. If you got your loan on April 3rd, your 8 weeks are probably going to be done about tomorrow. But again, with all the changes, I don't know a single bank that has opened up their forgiveness application process. So while the application from the Treasury is out, that doesn't mean that any banks are even accepting forgiveness applications. So important to, we'll keep everybody updated, and you will want to get them in as soon as you can. But at this point, there's no one's open for that.
Here's a question on, should we figure all this out prior to using the PPP money? And we'd say absolutely. Certainly, as you get in the first couple weeks, you want to prepare a budget and analysis so that if you maybe need to hire somebody back, or you're not able to spend all the dollars and want to issue bonuses or raises. Yeah, there's a lot of strategy, as you can tell, that you would want to incorporate into your situation. So you certainly should figure this all out prior to the spend of the money.
Another anonymous attendee lets us know that KeyBank is hosting a webinar tomorrow. We hope that they're watching our webinar tomorrow so they have the content for theirs. We joke, but we love KeyBank. We love all our banks. They're working super hard. We know that they're in the eye of the storm getting on forgiveness applications. Here's one. What if you hire a new employee? That's fine. That counts towards your FTE. So you can, in the example that we just showed, if that employee number 2 ended up being a new employee, that would count towards your FTEs. But the new employee would count basically based on when they started. Yep. Another one from Stacy Eggenberger. Hi, Stacy. Employee hours full-time, but their clock punches are 39.22, 38.76, and 40.33. Are they a 1.0 FTE? Again, there's a difference here. We get this question a lot. Should I use the simplified method, which would lead me to believe that they are a 0.5 because they're not 40 hours. Don't use the simplified method then if the majority of your employees are 39.22 FTEs or hours. Use the full method and count them as a 0.99. So you have the choice to use the simplified method. You do not have to do that. Here's a question from John Rowcroft. He's one of the biggest Buffalo Bills fans, by the way. I think he's been a season ticket holder going to games with his father since he was born. His question is, any indication of how long we have to keep employees after June 30th? There's no guidance on this to date. So as of right now, nothing's set. We know the intention of this program is to keep people employed. However, nothing has come out that says if you terminated somebody, July 1st, that you'd be penalized or lose forgiveness here. So I'm sure something may come out, but as of right now, we don't have anything. Got another one here about, just walked away. Here we go. Peter Schiller saying, I'm putting people on my payroll to do work around my office, flooring, painting. Is this okay to pay with PPP? There is no restrictions on what your employees do. They're your employees. You can ask them to copy things, shred paper, put together webinar slides. whatever, they're still your employees. I would shy away from, if they're doing work around your house, that'd be personal, but regardless, if they're doing work for your business, then I would say that those people are okay to be on your payroll for PPP.
We have a question here from Mamta, who's out in Michigan. Does employer-employee health insurance count? Only the employer health insurance portion counts.
Here's another question that came in. If I pay a former 1099 as an employee, is this a huge red flag? That's circumstantial based. So if they truly are your employee now, I mean, there's a lot of times when a 1099 subcontractor becomes your employee. Maybe you're using them for a couple jobs, and all of a sudden you're using them for everything, and they have no other work. Those are your employees. Will it get looked at? Maybe. There's no guarantee that your loan is going to get looked at. There's no guarantee that it's not. So the important part is, if they are indeed an employee, then I don't see a problem with it. If you make a 1099 person an employee, and then after PPP is up, kick them back to 1099, that's a huge red flag.
So we have a question here from Julie. Is there a significant difference between using the base period and calculating FTEs, the base period versus cover period versus using the safe harbor method? Seems like it's way simpler. Yes, there are simple methods and there are more complicated methods. Unfortunately, our recommendation is that you calculate it each way, like in the example that we showed you, and determine which method is best for you. Because again, you know, maybe what you do is start with the simple method, and that gets you full forgiveness. There's no reason to do the other methods. I would recommend you start there. However, if the simple method doesn't show that you'll have full forgiveness here, then you want to look at calculating one of the other methods.
Another question here from JP, Buffalo. 401k and health are above and beyond the 15K, correct? If so, can we put the max into our 401ks without it putting us over that 15K threshold and still get it forgiven? The 401k, there's nothing that says, now I believe, John, for owners, it might be different, correct?
Yeah.
Yeah, so for owners, you need to be careful because the retirement doesn't necessarily count. For employees, it's whatever they decide. You know, if yours is a match formula and they decide to pre-fund their 401k, that's on them. They've earned the match because they've deferred money. That would be a good thing to tell your employees to do, and get that match covered on the PPP.
Here's a question. We get a lot of questions on actually EIDL and how that whole thing works, and where is my EIDL? So if you received, this is what we found from our clients that have received this. If you've received an EIDL grant and it was automatically deposited into your account, then you should also be receiving an EIDL loan approval email from the SBA. Now, they are processing, close to 4 million EIDL loans. And what we found is some clients that applied for this, the very first day at the end of March, still haven't been notified, where others applied in April and have already been notified and funded. So I'm not sure, it's supposed to be a first come, first served basis, but I would say if you haven't received the loan email yet, I would say be patient and wait. We've had several clients actually call the SBA and they don't have much information to provide at this time. And someone also mentioned here in the question that they received a Visa card that I've never heard anything about. So I'm not sure what the Visa card is for. It may be for something completely unrelated to what we're talking about.
Yeah, I think the Visa card is for the economic impact payments, because reminder, if you did not have bank account information given to the IRS when you got your economic impact payment, they would have done it. They did it on prepaid debit cards, which are likely the Visa cards, probably what you're talking about, but not related to EIDL or PPP. Another question here from Brian Pratt over at CNR Vision, checking everybody's eyes, making sure I can see. Does funding the HSA count under paying for employee health insurance? The answer to that is no, currently. That does not count as health insurance. Health insurance is health insurance. That's your Excellus, your MVP bills for employees. and it's the employer portion, reminder that it's not also the employee portion. So currently HSA does not count.
Another question on just, will the 8 weeks get extended? We talked about that earlier. There are, pending legislation to move it to 16 weeks to 24 weeks. Nothing's official yet. We're thinking there's a good chance that will happen here very soon. And then Craig Camp at Action Towing has a question, transportation industry, would fuel costs fall under utilities? Yes, it's our understanding that fuel costs would fall under utilities in the transportation industry.
All right, so we've got Patricia Sunwoo, saying thanks all so much for the weekly hustle. And with that, I think we are going to end it. We're butting up right against that 45 minutes today. So we thank you guys for joining us. The Stay Strong, webinar series. Reminder: stay strong, keep up to date, stay with us. We'll keep hustling for you guys, and we'll try to keep this stuff going into the future. But we hope to see you guys. Keep seeing you guys every week.
Thanks everyone, and special thank you to Scott Spring for sending lunch over to the RDG headquarters last week. We enjoyed it.
It was awesome. Thanks, Scott. Thanks, everybody.